If you just opened an LLC, sell on Etsy, freelance on Fiverr, or drive for DoorDash, here's something most new business owners never hear from their accountant. Your LLC can legally write off thousands of dollars in its very first tax year. Even if you made exactly $0 in revenue, that is not a loophole. That is the actual IRS tax code, sections 195 and 79, and most new LLC owners leave every single dollar of it on the table. By the end of this video, you will know every major deduction available to a new LLC owner in 2026. Startup costs, organizational costs, home office, mileage, self-employment tax, and the QBI deduction that cuts your federal tax bill by 20%. More importantly, you will know which deductions are defensible if the IRS comes knocking, and which ones are the audit red flags TikTok keeps getting dangerously wrong. If you only have a W-2 from an employer, this video is not for you. But if you are a 1099 contractor or LLC owner, stay right here. Quick reminder before we get into the numbers, this is tax education, not tax advice. The strategies here are based on actual IRS code and IRS publications, but every situation is different and tax law changes every year. Always run these strategies by your own licensed tax professional before you file. That is not a suggestion, that is the smart move that protects you. Let me start with a deduction that surprises every new LLC owner. Under IRC Section 195 and IRC Section 79, you can deduct up to $10,000 in combined startup and organizational costs in your very first tax year. No income required. The deduction triggers the year your business begins, not the year it turns profitable. That means you can be sitting at $0 in revenue and still legally reduce your taxable income by thousands. Two separate buckets, each with a $5,000 limit. Deduction number 1 of 7. Let me break both of them down right now. Bucket 1 is startup costs under IRC Section 195. These are expenses you pay to investigate or create your business before it officially opened. Market research and feasibility studies, travel to evaluate business locations, advertising before your launch date. Attorney and accountant fees for business planning, not formation paperwork. The deduction limit is $5,000 in year 1. Here is a real example. You spent $8,000 on startup costs before opening your Etsy shop. In year 1, you deduct $5,000 immediately. The remaining $3,000 amortizes at about $200 per year over 15 years. The second bucket works the same way. Bucket 2 is organizational costs under IRC Section 79. These are the costs to legally form your LLC state filing fees, which range from $40 in some states to over $500 in others. Attorney fees for drafting your operating agreement, typically $500 to $2,500, and registered agent fees. The structure is identical to Bucket 1. Up to $5,000 immediate deduction in year 1, with 15-year amortization for anything above that. And here is the good part. When you add both buckets together, you can hit $10,000 in combined deductions before you ever make a sale. Here's what the combined impact looks like. Say you spent $4,800 on startup costs and $2,200 to form your LLC. Neither bucket crossed the $5,000 threshold, so you deduct the full $7,000 in year 1 with zero amortization. That is $7,000 off your taxable income before your business made a single sale. Tracking these two buckets separately and correctly from day 1 is exactly what PreFile Check helps you organize. I will show you exactly how that works in a few minutes. Before we go further, let me give you the legal foundation every deduction in this guide is built on. Every business deduction runs through IRC Section 162, which has a two-part test. Your expenses must be ordinary, meaning common and accepted in your industry, and necessary, meaning helpful and appropriate for your business. A copywriter deducting a style guide subscription passes this test. An Uber driver deducting car washes passes this test. A DoorDash courier deducting an insulated delivery bag passes this test. The question is not whether you can claim it. The question is, can you defend it when the IRS asks? Defending a deduction requires documentation. Keep every receipt, write the business purpose on each one, even a one-word note, and open a dedicated business bank account from day 1. That last step is critical. The IRS uses 9 factors to evaluate whether your LLC is a real business or a hobby. Mixing personal and business money in a single account raises every single one of those flags. Call it the iron wall rule. Personal money and business money never touch. Never. This one habit protects every deduction on this list. Here's the risk most new LLC owners do not see coming, If the IRS decides your LLC looks more like a hobby than a business under IRC Section 183, it can disallow every deduction and every loss you claimed, every single dollar. The safe harbor is profit in at least 3 of the last 5 tax years. A year 1 loss will not trigger this on its own. Startup losses are normal. What triggers scrutiny is a pattern of losses with no documented proof that you are actually trying to make money. A written business plan and formal bookkeeping records protect you here. That brings us to deduction number 2. Deduction number 2 is the home office. If you work from a dedicated space at home, you can deduct a portion of your rent, utilities, and internet under IRC Section 280A. But there is one rule that disqualifies more people than any other. The space must be used exclusively and regularly for business. A kitchen table does not qualify. A shared corner of the living room does not qualify. Dedicated space only. The IRS is not flexible on the word exclusively. Get this right, and the dollar difference between the 2 calculation methods might surprise you. There are 2 ways to calculate the home office deduction, and you should run both numbers before you pick one. The simplified method gives you $5 per square foot, up to 300 square feet. A 200 square foot dedicated office gives you $1,000 per year. Easy math. 0 depreciation recapture when you sell your home. The regular method takes more work, but often pays more. If your office is 180 square feet inside a 1,800 square foot home, that is 10% business use. 10% of your $24,000 annual rent, plus $3,600 in utilities plus $900 internet equals $2,850 per year. That is nearly $2,000 more than simplified for the exact same space. Which method works better depends on your specific numbers. One important warning before you lock in this deduction. Under IRC Section 280A, the home office deduction cannot create a business loss. If your LLC earns $0 in income this year, the deduction carries forward to a future tax year. It does not disappear. But it does not reduce your taxes today either. Of all the deductions in this guide, the home office is the only one that is income dependent in year 1. Keep that in mind as you plan. The next deduction has no such limit at all. Deduction number 3 is mileage. For 2026, the IRS standard mileage rate is 72.5 cents per mile, up from 70 cents in 2025. Take an Etsy seller who drives 4,000 miles per year to source materials, attend craft fairs, and visit the post office. 4,000 miles at 72.5 cents per mile equals $2,900 in deductions. No income required. Business driving is deductible regardless of whether your LLC is profitable, but there is one thing you absolutely must have in order to claim it, and most new LLC owners skip it entirely. You need a mileage log. Date, starting point, destination, business purpose, and miles for every single trip. Apps like MileIQ or Everlance generate IRS-compliant logs automatically. A spreadsheet works too, but here is the audit red flag that TikTok keeps spreading. Claiming 100% business use on a personal vehicle is the #1 audit trigger for Schedule C filers. The IRS knows you drive that car to the grocery store. Track your actual business miles. Do not round up. Do not estimate. Actual miles only, every time. That is the defensible number. Here's the tax that surprises most new LLC owners the most. Single-member LLC owners are treated as sole proprietors by default. Your net profit flows to Schedule C, then to Schedule C, where you owe self-employment tax at 15.3%. That is 12.4% for Social Security and 2.9% for Medicare. On $30,000 in net profit, that works out to about $4,239 in self-employment tax. That is in addition to your regular income tax. But there is an automatic deduction that immediately offsets half of that bill. Under IRC Section 164, you can deduct 50% of your self-employment tax as an above-the-line deduction. That means it reduces your AGI directly before the standard deduction is even applied. On that $4,239 self-employment tax bill, the automatic offset is $2,120 off your AGI, no election required, no separate form to file. It happens automatically when you file your return. Lowering your AGI also triggers additional benefits across your entire return, and the next deduction stacks right on top of it. On top of that, most LLC owners qualify for the QBI deduction under IRC Section 199A. This lets you deduct 20% of your net qualified business income from your taxable income. A freelance web developer with $50,000 in net LLC profit deducts $10,000 right off the top. In the 22% tax bracket, that alone saves $2,200 in federal income tax. The 2026 phase-out starts at $201,750 for single filers. File Form 8995 to claim it. A quick note here. This one gets complicated depending on your specific situation, so definitely loop in your tax professional before applying it. If your LLC is profitable and you pay for your own health, dental, or long-term care insurance, those premiums are 100% deductible as an above-the-line deduction. They reduce your AGI directly, which is more powerful than an itemized deduction. 2 limits to know. The deduction cannot exceed your LLC net profit for the year, and it does not apply to months when you had access to employer-sponsored coverage through a spouse. If you are paying out of pocket for your own coverage, this deduction is one of the most overlooked ones on this list. Let me give you the complete deduction checklist before we wrap up. Startup costs under IRC Section 195, no income required. Organizational costs under IRC Section 79, no income required. Mileage under IRC Section 162, no income required. Home office under IRC Section 280A carries forward if your income is zero. Self-employment tax deduction requires SE income. QBI deduction requires net profit. Health insurance premiums requires net profit. That is your complete first-year deduction map as a new LLC owner in 2026. 3 of those 7 apply even at zero income. The foundation for every single deduction on that checklist is the same. Your expenses must be ordinary and necessary, and you must be able to document them. No documentation means it did not happen. That is the IRS rule, not a guideline. If you want to verify that your deductions are actually defensible before you file, PreFile Check at PreFileCheck.com walks you through exactly that process. It is built specifically for freelancers and new LLC owners who want to know they are filing correctly before they hit submit, not after the IRS sends a letter. If this breakdown helped you understand your first-year deductions, subscribe so you do not miss the next one, and drop your answer in the comments right now. Are you planning to track your LLC expenses with a free tool like Wave, or would you pay for something automated like PreFile Check? One word is all it takes. That comment also tells this channel exactly what to cover next for freelancers and new LLC owners filing in 2026. The full deduction checklist is in the pinned comment below.